So I have a lot on my mind. A lot of it you're seeing in writing. You saw in the Weekly Roar, which just came out a little while ago. Uh, Kind of action packed, a lot of different things in there. And I would say that a lot of it is because we are really at a point in the markets and I mean also in our business development of the service where there's a lot of pretty cool things going on. Um, so I'm going to start with the market stuff. Then I'm going to talk to you about some things that I have done just in my personal portfolio relating to bond ladder and option collars, a couple things that I talk about occasionally and really only talk about with this group intentionally because I think that's part of what you pay for is the premium. Uh, so I'll give you my latest thoughts on that, and I'm going to introduce you to more of what we've done on roar.pytrade.com, our analytics site, and I will talk for a couple minutes here with Priyanka Ranjan, who is the CEO and co-founder of PyTrade. If you didn't know, she listened in last week, kind of audio only. But today, and hopefully many weeks going forward, she'll join in here and I think ultimately have frankly, hey boss, you can have whatever role you want on this, okay? You're she and her partner run the RIA firm, my old business and but not my current business, and so I provide the model information to them. That was their original business. Uh, where people can trade through the PyTrade app. But the thing we've really, really spent a lot of our time on is turning my Roar score and really my whole approach to technical analysis at building and managing your own portfolio from what I've done for other people's money and now for myself for 30 to 40 years almost, and streamline it into a single site, which is free, at least for now, and which I really want to try to make it so that everybody who wants a chance to learn from those sites as well as the stuff on etfyourself.com. Everybody really, really wants to is a serious investor slash learner, um, not somebody looking for hot stock picks because there's plenty of that out there. I wrote about this a little bit today. I want everybody who possibly can to take all this amassed knowledge and experience, frankly, that I have, and be able to map it their own way, or to piggyback off of what I do through some of the stuff we're doing with PyTrade. So uh, anyway, like I said, there's a lot on my mind. So I'll review the markets. I'll review a little bit about ladder and collar. I'll go through some of the research stuff. We'll chat with Priya for a little bit, and then give you a couple service updates at the end. So let's start with this. Uh, and I'll tell you this also. We can always use more feedback. Number one, we can always use more comments and questions. Number two, um, and frankly, we can also use all the reactions we can possibly get because, as you know, this is my semi-retirement gig. Sold my advisory practice when Dan and I ran for several years. Sold it 6 years ago. So, I'm kind of an open book here. And all I've ever really wanted over that time is to be useful and get paid fairly. So, to the extent that you can help us to help you the collective, since we don't give personalized advice, we want to hear it, and that is not just in general and services and things like that, features, but also just in terms of what I cover and how we cover it. So this week, I can't help it. I'm a sports fan. I was a sports fan probably before I was an investor because I started investing when I was 16. And I was a sports fan probably from the time I was about six, maybe seven. I think my first game at Yankee Stadium was when I was 7 years old. There's a story with that, but not for today. Anyway, so you'll see when you read it, but everybody's talking about this kid Braylon Mullins, who my friend from Indiana told me is from Indiana. So of course, a big source of pride. The play in the game the other day probably going to be iconic, unless you're a Duke fan. Sorry, but here's the thing. Nobody's talking about Silas Damari Jr. In fact, I didn't even know the guy's name. But if you're not familiar, it was a game to go to the Final Four in the NCAA tournament, and widely watched, widely followed, probably widely bet on with the brackets and everything. And Mullins was the kid freshman who made the big shot, and that's all the talk this week. Nobody's talking about Silas Damari Jr. Okay, if you watch the play, it only took about 10 seconds, but I'm sure it's all over the interwebs, as we say. If you watch, okay, before Mullins, the shooter, the hero, can even get the ball, there's like three or four other things that had to happen, starting with a Duke player trying to run out the clock and trying to throw the ball over a defender's outstretched arms, which normally you would think that would work. Okay, these guys are pretty good. Silas Damari Jr. was the one who gets his hand up, tips it, change of possession to Connecticut, and with 0.3 seconds left on the clock, he drains a three-point shot, and they win the game and go to the Final Four. What's this all about? It's not about basketball. It's about defense, and playing offense and defense at the same time. I didn't even write this in here, but I think for this group, I want you to hear this. When I talk about offense and defense at the same time, at the core of my investment philosophy, everything you see here, I'm not guessing about which way the market's going to go. I'm constantly balancing how much I can make with the risk of major loss, not little loss, major loss, that I'm going to take on the way to getting it. And that's what Roar is about, is just reading the charts through my eyes, but automated by the brilliant work that they've done over at PieTrade and roar.pietrade.com, which is our collaboration research site. So it's not about defense only. It's about including defense with the offense that everybody learns how to play. Nobody learns how to play defense. It's a good thing that Silas Damari Jr. learned how to play defense along with his teammates, because he's the one that, as much as anybody, made that happen. The rest of it doesn't happen. In the same way that in a portfolio, if you play good defense, you don't have to worry nearly as much about the offense. And the case in point, and I'll show this to you here because I think it's worth a little bit of a discussion. I call it bend, don't break. Again, kind of another sports thing. Maybe someday someone will hire me to do just a column merging sports and investing. That might be my dream job, yes. So here, make this a little bit bigger. Okay, so how do you bend and not break? Well, look, you know me if you've been with us for a while. Okay, I don't sit here and brag about my performance. What I do is I use my live performance, in this case, Roar 10 ETF, kind of the premium strategy, if you will, closest thing to what I did for years as an advisor, as a fund manager, running up to $3 billion at one point for a firm in the Midwest. The entire process started with the idea that you try to narrow the market down to as many or as few decisions as you can. And I don't mind making decisions on, based on the charts for what to buy and sell at different times or how much to own at different times. Um, but increasingly, you'll see here, and I did talk about this week, um, I will, um, I am all about simplicity. That doesn't mean I'm insisting on, you know, telling everybody just own a two ETF portfolio with SPY and Bill in it, which works really, really, really well. Okay. Compared to probably 80% of the stuff out there. I'll be researching that a little bit further to try to prove that, but I think that's probably close. Uh, but using the 10 ETFs and being able to narrow it down to what matters. It's not about saying these are great and the others stink, okay? It's about, I would call it sufficiency. What is sufficient to try to make money over time without losing big along the way? And that leads me to this. And yes, I know it was a big rally today. In fact, this might be the first day in several days where Roar 10 ETF may not have made money. It was down 1 basis point, uh, toward the end of the day, because that's what's going to happen. That is part of the trade-off that you make. Trying to remember what I wrote earlier today to describe. Here we go. Okay. Is it immediate thrill or eventual comfort? That's the caveman-like decision everyone makes. Okay. Because look, I could go back years and show you lots of stock picks, but guess what? A lot of stocks haven't made money in 4 or 5 years. A lot of big stocks. We just heard about the ones that did. So, rather than getting too granular, I mean, I can always do that. You guys know, I'll get granular with the best of them, and I will go through some individual charts and obviously take your questions. But it's how to bend and not break, and low standard deviation investing. Okay, what does that mean? Your value fluctuates in a much tighter range over time. That is the whole idea. As I've said, I think very recently here on this show too, the market gives you this very wide range of possible outcomes. The S&P 500 can go up 40% in a year. It can go down 40% in a year. That's about the historical range. I want to shrink that range. I want to shrink the minus 40 to way less, like maybe -5 if I can get away with it, and I usually can. And the plus 40, fine, I'll give some of that up. I still want to be able to try to make, 20, 25% in a great year, but I don't need 40 because it's not going to be like that every year. One of the things that I want to keep bringing front of mind for people is that we are now, let's see, 2026 into March. So we are about 26 years roughly into this decade. For about 45%, I'm sorry, decade, I mean century, okay? We are about 25, 26 years into this century. It might surprise you to learn that for more than 40%, almost 45% of this current century, 21st century, 40 to 45% of that time, the S&P 500's return was zero. Zero. I'll emphasize it. 0.0. Nothing. Nada. Nilch. Not nilch. Zilch. Whatever. But that's the thing. 12 and a half, almost 13 years, nothing. Nobody can predict when that's going to happen again, but just the fact that it's happened this recently, it just tells you that markets are so feast or famine, and we need to get in sync with that, especially because one of the biggest issues I think right now, and I'm struggling with this as a self-directed investor while I try to explain it to all of you. I think market function has broken down in a way that is even more than I would have expected. I trust the markets in terms of a tool to get what we want out of life. I do not trust that markets function in a way that is going to make what we've been used to in the past in terms of how prices move and what moves them and how violently they move, sometimes up on days like today, sometimes down on multiple days in March. That to me is the biggest reason why everybody should inch forward a little bit and learn to be a do-it-yourself investor. And that doesn't mean you have to do it all yourself, but you at least have to understand the arena that you are in. Not a sports reference there, but understand the arena, okay? Where what are you surrounded by? This is what I do not think most self-directed investors are quite aware of because they're being taught by many, many people with much bigger marketing budgets than we'll ever have. Uh, they're being taught buy this product, buy that product, trade this, do that. Okay. It's There's a cool and thrill factor. Okay. Like I said over here, there's a lot of immediate thrill being sold. Hey, it's not that it doesn't work. It just eventually leaves you open to kind of getting the financial version of getting hit on the back of the head by a 2x4. So you really have to think about this carefully. I'm one of many people that you can listen to, learn from, etc. But I feel like that is the most important thing, the most important message I can deliver to any self-directed investor who is trying to figure this out. Because I am telling you, this is not just weird. I think it is changed, maybe for the worse, which means we have to respond to it. Okay. This will be a sports analogy warning. When a team gives you your best, okay, you have to up your game. This market is giving everybody their best in terms of confusing the heck out of a lot of people, and where social posts can prompt a 2-3% move, rumors, etc. Okay. This is like 1920s kind of stuff, not 2020s kind of stuff, but it's the reality. So what do we do with all this? We have to have a discipline. We have to have uh, a core or a home base, if you will, something to come back to. For me, it's technical analysis, is charting ETFs and stocks. That's part of it. The other part of it is portfolio construction. And that's going to lead me into what's gone on the last 1 to 3 months here in the markets. You can see all this on roar.pytrade.com. It's pretty much all there. But a lot easier if I present it to you, especially for the folks who are listening to this and can't ask questions because they're listening to the replay. So look, this is a typical, dare I say, Rob Isbit's quarter when the market does this. Okay. For the full quarter, I have it in here somewhere. I think we probably ended up about 3% for the quarter. Okay. What should you take from that? All right. Up 3% in at least through yesterday, what was a down 7, and even the stock bond allocation here, the 40/60 stock bond, it was down a couple percent. What should you take from here? Not the raw number so much, but I want to. I don't want to point to this as like some kind of bragging point. I want to point to it as an example of what is possible when you have that lower standard deviation investment. Okay. I wish I had a long list of stocks and ETFs I could just tell you to go out and buy right now, but I don't. There's a few I will highlight, but that's it. And again, since so much is moving in sync right now, it makes it really, really difficult to be a stock picker. You can do it, and then you'll come back and say, oh, like you'll show it to somebody like me and say, well, what do you think of my stock portfolio? We used to do this all the time when we had prospective clients coming to us when we were as an advisor. And they say, okay, let me show you my portfolio. Great. And I knew every single time we could have the same bullet points when we would review it with them formally. You own a collection of investments. You own too many things that move in sync with each other. A lot of times it was mutual funds or ETFs, but even the stocks. And I mean, it may be great for the TV media and the product sellers to convince us that there's 4,000 ETFs and they're all different. I'm trying to figure out if there's even 20, 30, or 41% of them that it's not that the others are worthless. They're just redundant. And how many times do you want to own the same thing and go into every market era thinking I'm diversified when you're absolutely not? And this is one of the biggest issues, I think, of our time because so many people have learned to invest on their own and they've learned ways that skip over a lot of what I would call the critical thinking and scrutiny that is applied sometimes, but not often enough. And look, that's what I'm here to do. Okay, I was always a due diligence research type. Of course, I managed a lot of money over time, but uh, so understanding how the markets have changed and what still works and what's liable to get you in trouble, even though it doesn't look like it will. These are all, I think, parts of the kind of ETFyourself.com mission. So look, yeah, I mean, the Qs were off, I don't know, closer to 10%. I, I don't really want to focus too much on the numbers other than to say, uh, I think that a conservative, risk managed style has a better chance of making what it did this quarter, 3% positive return in virtually any quarter, no matter what the circumstances are. Now, to me, that's a pretty powerful statement, unless you're a young gunslinger, trying to make your first 100,000 or first 50,000 of assets. Okay, when you get into six figures, seven figures, eight figures, it becomes more about, yeah, of course I want to make a good return, but I don't want to give a lot of it back. And that's what. And again, it's not about, I'm not swing trading this thing. Okay, it's about starting with a structure, 10 ETFs, ROAR as the guideline. Okay, I think it's fair to say that my decision making was even cleaner this quarter than maybe it's ever been because of RoarPieTrade.com and the work I've done with PieTrade, because it's like having a a second set of eyes, okay, that produces these scores every day. And yeah, we're sharing all this with anybody who wants to sign up. There's no charge. The research site. The question I think everybody has to figure out in the coming weeks and months is, how much do you want to try to figure out how to do all that on your own? And how much do you want to kind of say, okay, I'm going to learn by watching, whether it's copying or getting, looking at the models and doing it that way. That's everybody's own decision. So again, I would say that and not just mine, but when you play offense and defense at the same time, you have a better chance of making a positive return in virtually any environment. Take a quarter, take a year. Much better chance when you manage risk and don't just play offense all the time. Um, Maybe you don't have as good a chance to make 15% in a quarter, uh, but you know you're going to be able to control your own destiny. And to me, that's what investing is all about. So just a little bit also just kind of statistically, okay? It's all about the drawdown. Now, look, I don't mind telling you, okay? I mean, this was, I wouldn't say it was even good for me because I've had, quarters where probably had smaller drawdowns, all right? But, the don't look at the actual numbers. Look at the fact that it was possible to produce something like this. And it was not, to be clear, because I loaded up on all things energy and commodities early in the quarter for gold and then later for oil. Yeah, it's because those things are in there, almost like a permanent portfolio concept That's really the what I'm trying to get across. There are 10 ETFs in this portfolio. They don't have to be the same 10 that you use, but there is equity exposure. There is inverse equity exposure. There is market shock volatility flies exposure that that detracts from performance on days like this last day of the month. Uh, there is bond allocation. There's also inverse bond allocation, so that you can uh, you can profit from rising or falling interest rates. And then there's commodities, and even gold is a specialty. So it's those 10 buckets don't have to be your 10 buckets, but my point is figure out that there are some go-to buckets, and don't worry about am I in or am I out. Okay, I've been writing about this a lot in the Daily Roar. Hopefully you're enjoying that. Uh, it's not a matter of in or out. In the 10 ETF and in most of the portfolios that I'm running here, the model portfolios, the rule for most of them is you own everything at all times. The only question is, do you own a little where it's not really going to impact you that much, kind of like a lot of the stocks in the S&P 500 that have such low weight that they don't matter? Or is it going to be a higher weighting where you do have more confidence? In other words, that's a higher ROAR score for me. Or are you somewhere in the middle? So it's thinking in terms of building a portfolio, whether you ultimately build it or you just use what we do here to help you better understand how I build portfolios and how I've been building them for a long time. So there's a little bit more on this here. Um, we had some requests for this here, but you can see, I mean, again, I mentioned here, it's a snapshot. Okay. So as we sit here on Tuesday afternoon, when I did this a few hours ago, it could be different if the market is crazy up or crazy down tomorrow. Some of these could change. But what I will emphasize is, the equity allocations are pretty low, 10 each to Qs and DIA. PDBC, which is the commodities, which of course have been, just swimming in the oil thing, which of course today could be very, very tenuous. I'll show you in the charts. You got, it's an 8% allocation. My guess is that's going to be downward biased soon, unless the news changes, and that's part of the problem, okay, which is why I'm trying to simplify. Too many of these things move up and down together, right? Don't you know that equities are going to move up when oil goes down because of what's happening in the Middle East right now? That gold sometimes will beat to its own drum, sometimes will follow one of these. IWC, which is microcaps, basically minimum 2% weighting there. And this is how you do it. It's not guessing. It's saying, okay, am I high allocation, low allocation, or sort of neutral or average allocation? That's what this whole structure is about. The VIXI ETF, which is the really volatile one, that's about average. But look, 48% cash. Okay, that's why this can't rally on days like today, nor should it, because we don't know what tomorrow's going to bring. And as I'll show you in the charts, you know, one day. In fact, I'll go out on a limb here. Maybe this will look a little dumb in a few weeks, but when you see days like today, where one piece of news comes out, boom, 3% move in some of the indexes in like hours. Um, not every time, not every time. I think last April was an exception. But most of the time, when you see flash rallies like that, that is symptomatic of a bear market, not a bull market. I'll leave it there for now. And I'm sure that I can do plenty of research on that, and I will, especially because I've learned how to use AI because it does it so fast. If you know what questions to ask. Anyway, and then on the bond side, look, I mean, I'll show you when we get to some of the ETFs here, and the charts, as I'll do in a minute. Uh, this has been a very difficult area to try to make a decision. That's why 5% long this laddered bond ETF that I like to use, and 7% inverse. So basically, inverse long bond. You put these two together, it's kind of like a slight net short bonds, and that was pretty handy when rates have been going up. Um, in fact, before I get to the ETFs I'm watching, let me take that little aside and just comment briefly on ladder and collars. So, one thing that I love to talk about, would love to talk about it more, but I don't foresee during my lifetime that um, leading with the bond ladder concept is going to uh, cause a lot of people to listen to what I have to say, because there's a whole generation of investors that have not needed to learn anything about bonds. But here's the thing, folks. Let me see if I can pull this up here. In fact, I'll show you. If you want to get a great look at the bond yield curve, this is my go-to, USTreasuryYieldCurve.com. You'll see it in a lot of my articles. And boy, it's looking interesting now. Okay. Very, very flat down here. So this is a way of saying, all right, you can invest in 1 month treasuries. You're not going to make 3.74%. Oops, not going to make 3.74%. You're going to make 1/12 of that. Okay. Boy, they added even more ads to this thing, but it's basically a free site. So look, you've got still more than 3.5% here. This is being pushed down quite a bit because everybody wants short-term paper from the U.S. government, because recently they have not wanted long-term paper from the U.S. government because they're worried about what's going to happen to uh, the the national debt, 40 trillion and counting. Oh wait, maybe it's 41 now. I mean, it's like it's moving up that fast. Let me see. I'm going to pick a date here. There we go. Okay. So you can choose one or more dates here, and you can see the difference. So what's happening with bonds? Okay, I use this a lot. I mean, I use the charts more. I will chart Govy and TLT and some of the other stuff. Okay, even the high yield stuff, but not a whole lot of change at the long end. Okay, but what you can see here is that the 2 year popped up. When I saw the 2 year yield pop up that high, uh, I grabbed myself a, a couple of big handfuls, okay? And I altered slightly the bond ladder that I have been building and maintaining. I don't build a bond ladder like most people do. I build it with the idea that at any moment I'm going to need to hedge it. So my bond ladder, the core of it is still about 5 to 15, almost 20-year maturities every year, and there's zero coupon treasuries. I have money coming due. Okay, I can tell my wife Dana, also my business partner, for decades, that we have this much money coming due every year on this date, as long as the Treasury can pay us. And as I've said before, they'll pay us. Maybe it'll be with inflated currency, and so it won't be worth nearly as much. And that is one of the reasons that I hedge the ladder. How do you hedge a ladder? Inverse ETFs that go up when bond rates go up, not to mention uh, options. You buy put options on things like that. There's even things you can do in the equity market. I'm probably going to spend more time on that at some point, but this is not the era of markets to do that just yet. But I think there's lots of ways to hedge it. So I've got that core part of the ladder where every year a certain amount of money is coming due. I can add more if I want to protect from inflation. I can hedge it to stop what's been going on. I mean, I had some big returns on TLT put options, which helped offset somewhat the losses, temporary losses on the bonds. But remember, bonds, particularly zero coupon bonds, you're getting that money at the end. The only question is inflation going to impact it? And that's what I hedge. The big shift I made was, if you will, at the ends of the ladder. Okay. So this is kind of the core of the ladder right in here, and you can see trying to get higher and higher rates. But I'm not so sure I trust this just yet, because there's a possibility that the U.S. could really blow it in terms of increasing the deficit and not taking care of it, and the market will really start to care. That could all really go wrong. So I downsized this a little bit, and I made it a single 20-year bond purchase, which of course is easy to hedge because TLT is like 20 to 30-year bonds. But the other thing I did, which was probably the more significant move, is I shaved off a little bit from the ladder. So, for every $1,000 I had maturing in a particular year, maybe now it's 700 or 800 instead of 1,000. And I piled a lot of that into here. Why? Because the yield is fairly close, and I want a free look. I got a 2-year free look at with the zeros. It was probably about 4%. It was right on 4%. 4% for 2 years. You might be surprised, folks, at how competitive a return that is, with what I'm seeing in equity land and the possibility that longer term rates would go up. This is all very pliable, fungible, whatever you want to call it. Okay, it can be maneuvered, and that's the whole point. But I think that there is an art to the bond ladder and a science to it now that is more relevant than probably the last 20 years, because look at where rates are. In fact, I'll put one more thing in here. Hopefully it's not too inefficient. Let's see. Yeah, I will do this. Let's go back to where rates were. Perfect. Okay. This is where rates were, let's call it 4 years ago. This is what the yield curve looked like. If you're not used to looking at yield curves, let me tell you, this is historically awkward. So right now, yeah, the short-term rates, I mean, where were short-term rates 4 years ago? 1.7, 1.75. If I go back a little bit more, you'll see them even closer to zero. Okay. Long rates were finally up there. Oops, you know what? I just realized. Hold on, I screwed that up. It's supposed to be 22. There we go. Nope. There we go. Okay, that makes a lot more sense. And actually, that's the end of 22. So I'm going to make that end of 21 so I can show the part I'm at. Hey, that's what I've been trying to show you. Okay, so end of 2021, where were rates? Okay. 0.05%. An undesirable grade point average in college, for sure. Okay. These were all tiny. This is 1% right here. You see this? That's 1%. The long bond was 2%. There's a real world implication for this right now. The U.S. Treasury issued a ton of bonds here at all different levels. These are coming due now. Okay. And guess what? They got away with borrowing money from people for 1 to 2% for 5 to 10 years. Not bad if you're the U.S. Treasury. Now, this is where they have to reinvest, and it's creating all kinds of problems that do not make the headlines because it's not a very sexy topic. But it's one of those things where when you read the documentary about what happened in 2026 or 2027 and how everybody should have known, Big Short kind of stuff, it'll be like, yeah, these are all things that preceded it. And that's, I think, look, being a risk manager is not about being a downer or a gloom doomer. It's about trying to identify where my money could get screwed up. And so we tried not to screw up to make that happen. So here's where the curve is right now, and you can see a dramatic difference. And we go back over the last 20 years, you haven't seen rates anywhere close to here. Yeah, I know inflation's on the high side right now, but maybe that's temporary, maybe it's not, and I can always hedge it. So I'm looking at this and I'm saying, wow, this is really good competition, not as a replacement for stocks, but as an allocation alongside stocks. Because if you even take in simple terms half your portfolio and you're making 4% and you know that's what you're going to make, okay, it's established now, 4%, before inflation. If half your portfolio is making 4%, you could actually lose 4% a year for like a decade on the other 50% of your portfolio, and you'd still break even before inflation. So think about the usefulness of that. And while I'm explaining this in terms of bond ladders, a lot of what I do in the portfolios, okay, with the allocation of Bill and whole thing, similar approach. And look, I mean, Bill's 48% here. Okay, this is the automated version of the model, not the one I run manually and make final adjustments to on Wednesdays. But you can see bonds are well represented here for their pliability, not because I just want to buy bonds and hold them, but I think they're part of a tactical mix. Okay, let me go through. I mean, you'll be able to read about this, but I wanted to point out a few things just to kind of summarize my views on the ETFs and the markets. Look, I'm looking hard for bounce candidates. I mean, at least bounce candidates. The number one place I'm finding it is in things like materials, gold, a little bit in the gold. Steel is another one I wrote down. But again, it's all going to the same thing. Okay, I can collect a lot of these together. I'll try to cover this in Daily Roar the next week in some of those posts, or at least in some of my bar chart articles, which is kind of an extension of that. Um, you know, this means that everything remotely associated with the material sector is probably going to move up and down together because that's what happens now. So why do steel stocks look good? Let's say while oil maybe is topping out, unless there's another war headline, of course. Um, you know, because it's it's part of the index. It's part of the material sector ETF, and so much more flows into these than flows into the single stock or the niche ETF. That's why a lot of ETFs are, like I said, not useless, but they're redundant. And if you don't know it's redundant, that's where the danger comes in, because then you think you own something and it's not what you thought. Okay. Um, and look, I mean, here, except for the recent pop in oil, uh, XLB, material sector, looks very similar to PDBC, which I have in the portfolio. It's a mixture. Got energy, it's got gold and silver and lots of other commodities of different amounts. Okay. These Roar scores are not going to change much. XLB is at 20. Every sector right now is at 20 except for one. Which one? Energy. Okay. Uh, but again, and I think this will be a good way to lead into what we're doing with Pie Trade. Okay. You'll be able to see this in your copy, but I think for those who tend to like watching the video instead, okay, the Roar score is not perfect. It's not a buy sell indicator per se. It's a measure of how much risk are you taking when you take risk. And sometimes it works about as close to perfectly as it can. And this is usually stronger trends. When you have markets that are flippy like this, any technical based system, and that's what this is, anything based on technical analysis, price trends, momentum, things like that, are going to be very schizophrenic before they finally find their footing. I'm sure if I went back a year before this, you'd see a lot of waffling signals because not much was happening. But it finally hit the green zone for a little while, and this ended up being a great place to buy it. Ended up rallying 35% in about 10 weeks. Not bad. Can you use this for day trading? I wouldn't advise it. I mean, we're always trying to improve the score at the margin. We're working on that right now. See if we can take what we have, make it even more precise. Um, if we can, maybe it will be a trading tool, but I'm not willing to declare it that yet. Okay. Now you're in this yellow zone. All right. And I'm looking for, okay, is that going to, because look, I mean, we have energy exposure. I mean, I have energy exposure in the 10 ETF through PDBC. About half of it is energy related. What did I say about the way the markets work? Energy, MLPs, drillers, the oil price, oil stocks, large cap oil stocks, small cap oil stocks, foreign oil stocks. They're all generally in the same boiling pot. Okay. They're moving up and down together more than they ever have. So I'm watching to see. I will tell you this: when you put together the story of materials, energy going up, I don't mind telling you if you look at some of the stock stuff. Okay. And here I'm just looking for, hey, you know what? It's double bottomed here. Maybe it'll happen. If some of these things, there's a lot of charts that look like this. This is what I would call last chance. Last chance, Nike. Last chance for a lot of stocks, a lot of healthcare stocks too. If it tries to bottom and this PPO rolls over and it breaks through this old low, see ya. And I'm talking about the broad market, not that one. I see a lot of them. Okay. Maybe Goldman will save things. The financials look, let's call it, ready to try to bounce. It could change in a day, but they're getting close. A little bit of retail. This all plays into one, let's call it, the war is not going to last for months and months trade, because that will bring oil prices down. That will bring consumer costs down. Why that's an impulse for people to go out and buy Nikes and clothing and things like that, and entertainment venues, and I don't know, maybe the cruise stocks will rally. It doesn't make sense to me because there's a lot of other things that haven't changed. But you need to understand here, this is the mentality of how markets work right now. It's not controlled by you and me. It is controlled by algorithms and index fund flows. And so we really have to be careful that we think that we're investing when all we're really doing is we're using these tools, and we are, if you will, engineering, okay? Engineering returns. That, I think, is how investing is done now, engineering returns. Okay. So this is, I think, the best part of the show, where we spend a few minutes talking with Priya, because I think it's going to be very important, since pie trade, we're at pie trade, the thing we're working on, together. We are working on a lot of things together, really on a research side, okay? Because again, I'm not an advisor anymore. I'm not registered, I'm not a fiduciary, none of that, okay? Right? This is all research on my end. But the way to take research and, well, two things: taking research and bringing it to life the way we have in the Roar Pie Trade site, which, if you haven't gone to, I encourage you to, because we're adding a lot here. But this is the other outlet for my research. There's only so much I can do in a Substack, writing and cutting and pasting. There's a whole risk management and investing system and portfolio construction system. It happens to feed into the original pie trade, which I think was their plan before we met each other. And that is a different function, but it's a way to trade or have things traded for you with people in my position, the researchers, the model creators, sitting on the outside, as I say in the note this week. If you end up copy trading, and I mean, several of you have, great to see, very, very exciting. Um, but if you are, I won't know it because that's the other side of the wall, if you will. If you tell me, great. Hope you will tell me. I'd like to know who's following the work. But that's the sort of separation. So I wanted to make that clear. Okay, Priya. First, give these folks a little bit of background as to how pie trade came to be, and then uh, quickly move into kind of what you see happening that would maybe be helpful for them to know about current and looking forward, since we're doing a lot of work together.
Yes. So first of all, I'll just give you a background, like why pie trade. Like, so I left my job at Goldman Sachs. I had a very good job, and I'm a mathematics and computer science graduate, but I left all of that behind to work on pie trade. And the reasoning behind is like, so I'm from India. When I moved to US like 4 years back, the one thing like I am into portfolio management, quant strategies as well. So every time my friends will ask me, oh, what to invest, what to buy, what to sell, like every day I get like 5, 10 queries. But the problem with this is like, we don't know exactly what your risk appetite is. Maybe my friend, someone is not that well off, or someone is very well off. Everyone can have a different risk profiling. And then all of my friends, specifically, I'll say the young generation, are too much into social media and trying to just copy anything and everything they just hear. Oh, there's a buzzword for this. They start doing it. So that's what the problem that we are trying to solve. Now, copy trading has been a word around like for a long time. But the problem is it was never solved properly. Because I have heard people copying someone watch list. I don't know what that is.
By the way, Priya, explain. It's always good to hear, as even if you heard it before. That because copy trading, I think some people are familiar with it, but I would say more than half the people I mention it to are not familiar with it. So
Yes.
how does that work, and how is it similar and different from the way we've all opened investment accounts over the years?
Yes. So right now, if you will get into like copy trading, like first has been a concept from eToro slightly where it is like you are copying one person, like you are copying something like Rob or Priyanka. But my risk appetite again is very different than yours. Maybe I'm taking very risky bets which you don't want to take. There was some flaws in that. The second, the execution is not real time. So what is different in PyTrade? The moment, suppose Rob is buying something in 10 ETF portfolio and I'm copying Rob's portfolio, it's within milliseconds I'm talking about, like seconds, all the trades are getting executed at the same price. Whatever price Rob is getting, I'm getting the same price. So this has not been existing. Earlier, technology was not that advanced. Like we are using AWS services, we are using like the latest of the technologies, and we have built ourselves as well to optimize. This was not existing. So earlier, what used to happen? Oh, Rob placed some order at 10 a.m., but my order will execute at the end. The other type of copy trading was like, oh, like I just know what Rob is doing. I get a alert on my phone like, okay, this is what I have to do, and then I go and buy. And this is what is happening right now with Seeking Alpha. I was talking to David as well. So they are facing a lot of challenges because they send the signals to users. Now if you miss one or two trades, then Seeking Alpha is saying we made 50% return, but the users are seeing minus 10% return.
Oh, now with Seeking Alpha, because Seeking Alpha does not have a does not have a sort of brokerage investment arm.
Yes,
Are you
they don't have the
saying you're saying that you're talking about like what with the what do they call it, the stock the quant?
Yes, the
the
quant.
quant portfolio. So they, right, because that's the closest thing they have to like a model portfolio. Is Steve Kress does really good work there, and the quant portfolio. You're saying they send out signals, but then it's up to everybody to see the signal, implement the signal. Do I? Oh, should I? I don't really know if I want to buy that one. And I guess the other one I think that I always think is underrated, position size. It's one
Exactly.
thing to say, here are the picks. Here, I'm going to have a 20 stock portfolio. Well, maybe some of them are 10% positions and some of them are 1% positions. That's
Exactly.
where all the performance comes from, right? It's half what you own, and the other half is how much of it you own or how little of it you own. That's why I talk all the time. It's all about portfolio construction, and that's kind of what we built, here.
Yes. And risk management. That's why the allocation is very important. You are giving 10% or 20%, that will define the risk of your portfolio. So, yes.
Yep. And I think in the one that really came out of this group, the original version of this group, is the Chew ETF portfolio, where is nothing but SPY and Bill. Okay, and just so you know, okay, this one's very simple. Whatever the Roar score is for SPY, you might have caught it a few minutes ago. The Roar score for SPY is 20. Well, that implies that there's going to be a 20% allocation to SPY. The rest, where does it go? 4,000 ETFs, but I'm only considering one. It's cash, it's stocks and cash. That's it. And so all this represents up here, okay, this is, you know, Priya was just explaining copy trading, which is that next step, right? You interact with brokers, open an account. You folks are a registered investment advisor, so you're the fiduciary here. You're the one that makes sure that I guess there's some degree of risk tolerance testing, but for the most part, the copy trading platform that you have is a little bit different from like having a full service, full cost financial advisor, because um, people who are using it, basically they are making the decision as to what they put the money in, right? They make, if you will, the strategic decision of what models to own, and which ones to copy, but they are not, they're all they're really outsourcing is the time and price of the trading within that style, and what that style will own, right? Is that kind of the difference?
Yes, yes, I'll say that. It's exactly the same. So whenever the experts are trading, like you are choosing just the model and that's it. And the good thing is you can see the risk, you can see the historical return, the allocation, you can read more about that. You have all the information that is required for an informed decision. And
Mm-hmm.
there are risk systems that we have built. Like, suppose the risk of the portfolio, like someone wants to add a penny stock to it, it will instantly show to the trader that you are changing the risk of a portfolio. And this will alert every user copying it. So it's not like you just put the money and left it like without any like a surveillance here. It's like we have the systems in place to help you check, and all the execution is with us, so we will do instant execution.
So one more question for now. Uh, the Since interactive brokers, I mean, we used to always say this because we custodied with Schwab forever, and people would say, okay, well, what if something happens to you or whatever? It's like at the end of the day, the custodian holds the money. Okay, um, I don't mind saying that with what we have created on the Roar.py trade side, on the research side here, which potentially feeds into the copy trading, but this is separate site, separate business, et cetera. Uh, you know, I think it's fair to say that what you folks have done is, in terms of my approach to portfolio management, you've allowed me to live forever. Thank you.
Yeah, I'm
because
glad.
because some of these have a little bit of manual intervention, Okay, a little bit. This one does, a couple of these, the more complex ones will. I'll go over some of these probably the next week or so. Um, yeah, you like that. Go big or go home, right, Don? What about QT Pie? Yes, I came up with these. If you've been reading my writing for more than like a minute, you probably know that I came up with the names. But for some of these, it's like, okay, I mean, yeah, this is basically taking the decision making out of my hands because some of these simpler ones are automated. So literally on Wednesdays, okay, if I have an account in one of these, all right, boom, there were trades made, right? Uh, so some of them are fully automated. Others, like with this one, okay, um, it will, I'm going to see tomorrow morning, I'm going to see this, and I'm going to go and do my double checks and my charts and whatever else is happening, monitoring the markets and et cetera. Because look, I mean, I could technically change it at any time, but the idea is to trade only on Wednesdays. And again, I'm talking about me, my personal experience and my process every week. But part of it is so that you can think to yourself, oh, I'd like to have a process. It can be as close or as far away from mine as you like. Just have a process. This is what I talk about all the time. But I will look at this on Wednesdays and I will make a final decision. And in my mind, unless something really crazy happens, I'm going to stick with it for at least a week. Okay. And hopefully, just let this guide me. Why? Because the automated version of it, I dare say, versus the chosen benchmark here, 40% stocks, 60% bonds, it's done quite well. And that's the other thing here. Uh, if you look at this over a period of time, and I'll drill down on this a lot more, probably starting next week. Maybe put a little bit out in some of the posts, but I mean, look, this is not supposed to take a lot of, risk. Okay, I think we're adding a standard deviation here, which will be helpful. But you know, if the 40/60 portfolio had a 20, almost 21% drawdown since 2020, which is what your measure is from, and you've only managed a drawdown of 8%, so well within 10%. Okay, not sure how many Sharpe ratio fans there are, but having a robust Sharpe ratio as opposed to virtually none, um, probably we'll add alpha or something like that to here. But there's a pretty good spread here, and um, being able to do that, but also understanding that I didn't touch a thing. I built the strategy. I built it very carefully. Okay. But, and yes, it's a back test. Okay. But if you look at things like, I'll just show the other one. This is the one that, I mean, ever since I've been running live shows and newsletter Substack, beginning of 2022, I believe. Okay. So this is pretty much what I've been doing since the beginning of 22. We did run it back to here, and I have live performance with it. But my point is, folks, this is not about necessarily, Rob being a brilliant money manager or not being a brilliant money manager. This is about Rob being an expert in something else, which most people really do not even offer to the public. Portfolio construction. And the finished product you may like, but if you at least learn how to build a finished product so you can either have a higher confidence level in one of the ones on that platform, mine or anybody else's, or use it to build your own. Um, and so again, this is about the simplest thing ever. Okay. I got money in SPY and money in Bill. Well, this is why I'm convincing myself more and more that, well, wait a minute. If you're a conservative investor and you can have this type of spread over now 6 years and 3 months as of today, and you can generate this much return over a conservative portfolio, conservative benchmark here, AOK is 30% stocks, 70% bonds. All right. lower drawdown, etc. Okay. What this is telling me is that not any one portfolio, but dare I quote uh, Steve Austin, played by actor Lee Neighbors, the $6 million man, which Priya is way too young probably to remember. Okay, but the TV show on Saturday nights, eating the TV dinners, right? Steve Majors, right? Steve Majors? No, it was Lee Majors, Steve Austin. Anyway, I'll argue with Don on that one. Okay, what was the famous line in the beginning? We have the technology. We have the technology. Okay. I had the process, PyTrade had the technology, Roar.PyTrade is the middle. And oh, did I mention it's free for now and for the foreseeable future, I think. Priya, if you can, just comment briefly on where things are going mechanically, because look, this is one segment. The others will listen on the replay. Hey, this is the inner circle for Rob and Sun Garden ETF yourself. Okay. You folks are the inner circle. You're the ones that either come here or you're one of the in one of the premium levels. Hey, you're the ones that if we're ever going to build around anybody, it is going to start with your input. And I'll have more to discuss on that before we close up today. Okay. Priya, so yeah, give us an idea, kind of what's in the works as you see it.
Yes. So Rob, like first I'll get into Roar.pytrade and Pytrade. So Roar is more will be a research platform. It will cater to the DIY investors as well who want to do their research, understand more. Right now, it's very much centered around just Roar. You can see news as well, financials as well of the ticker when you will search. But then
Hmm.
here you will see more informations coming up. It will be a stand-alone research product. Then you don't need like, okay, trading view and all we use as well. But here you see like there are more things coming up. And gradually we'll be adding more. And if I like to have input from here as well, if someone has like, oh, I need this and that, so that will be useful for us. But the goal here for us is to this is our research platform. Rob is a person who understands all about the market, who is into the portfolio construction. He'll help us guide how the risk we should be thinking about. Right now, if we think about the market is like very bad, except today. So at that moment as well, how the allocations will be like, how the research we should be thinking about. That is one arm.
Hmm.
And pie trade, the way we have the vision for pie trade is like right now it's catering more to the copy trading, but now you, if you know, you can trade on your own as well, like Charles Schwab or Robinhood. So right now it's stocks and ETFs, but we are going to expand it to different asset classes as well, especially crypto. So this is how we want to make it a one-stop solution. And you can copy friend, family, anyone over there as well. So that
And
is
and that's what the create your own button is about. You literally, this is just a free playground here.
yes.
I mean, I started in this to build the ones that I built for here. We just had it, kind of behind the curtain. So, okay, great. All right. Well, thanks. Anything else you'd like to share with the group for now? Otherwise, we'll get to the final section here and close up.
Just one thing,
Sure.
I'm looking for like as many feedbacks as possible on Roar and PyTrade. Anything
Yes.
anyone has, please like just message me like support.pytrade.com or priyanka@pytrade.com. I'll be happy to look into all the feedbacks.
The other thing, and you can, send this to us, info at sungardeninvestment.com or any other way you care to reach us. Um, we are going to be putting together, I don't know if you call it a focus group, a early adopters group, uh, the inner circle, if you will, not just for me, but to help these folks because they are kind of an extension of 40 years of my research. So, and they're the ones who brought it to life and made it easier to use. This is what I've been pining for a few years, and finally we found it. So, pretty amazing. But we're going to want people that can be sounding boards, not just for what you think of it, the people that like to dig in and try it and all that, but also what you want from us, particularly me, because uh, there's a lot I can do for the rest of my career. What I really want to do, like I said, is be useful and get paid fairly. So, and we have brainstormed. I mean, look, I'm kind of open book, all right? We've thought about, all right, would there be some sort of higher end, like club, where assets under management, type model, okay? Put in a certain amount of assets under management, charge a discount fee, they're the RIA, and you get all the research with it. So it's like a hybrid of the do-it-yourself investor, and I would call it the assisted do-it-yourselfer. We have talked about that conceptually, haven't moved on anything yet. Um, other ways you'd like to have this information disseminated, things that we can do to simplify or explain all the things that you are seeing. I've even considered carving out. Again, this is not for everybody. This is, I'm going to say, could be 20 to 30 people maximum. Maximum. I think we've got um, 2,500 people watching our stuff, following our stuff on Substack. Okay, 1 to maybe 2% of them would be what I would call inner circle, and they self-select to be part of that. To say, okay, I want to work more closely with you. It's not a fiduciary relationship, except with with what they're doing, but where you can really uh, get what you want out of it in large part by telling us. And that may take the form of any of the things I've discussed. It could be that if enough people said, "Hey, Rob, could you run basically A to Z sort of 101, 201, 301 of investing in portfolio construction? Can you create a course on teaching people to construct their own portfolios?" I'd love to do that. I can't do it for free, but I could do it, and it could be a session over a month or two, and then we'd break, and then next semester, and the whole thing. I mean, I'm kind of a professor at heart, so there's that type of thing. There's we even thought about small group, or even, dare I say, one-on-one investment coaching. I wouldn't tell you what to do in terms of saying, giving you direct advice, but I can help you to think in ways that will lead you down the decision funnel so that you'll decide to do what'll be obvious to you. I don't have to tell you. Um, so a non-fiduciary coaching could be on an hourly basis. I mean, all these things are possible. So I wanted to tell you folks live, and I want everybody who listens to see this. Maybe we'll have a few video cuts of this too, because we want to be able to deliver something. I mean, we already deliver something I think it's highly unique, and especially now with putting rohr.pytrade on top of it. But it's useless unless it's useful to enough people. And so we are starting with our inner circle, because together we're gonna try to have a bigger voice for this, and let anybody partake in what we've built, who would like to. So anyway, that's that. The last thing I'm going to discuss, um, and I'll just say it very briefly, and I welcome anybody who wants to learn more about it, ask us questions, etc. I would ask that if you have any questions on this, email to info@sungardeninvestment.com. Info@sungardeninvestment.com goes to Dana and me. So you'll get notice in, well, I guess it'd be 3 weeks from yesterday, it sounds like. We are going to be uh, moving off of the Seeking Alpha Investing Group platform. That means virtually nothing in terms of us working together unless you wanted to. Why are we doing this? Very simply, we started on Substack. We moved over to Seeking Alpha Investing Group. It was a great honor to be selected. I think it was the only one in the year 2024 they started Investing Group for. Uh, we never really left Substack and then kind of built it up again. We've gotten to the point, frankly, this is not, if you're expecting me to say anything negative about Seeking Alpha, no, you're not going to hear that. I love Seeking Alpha, and I'll continue to be writing on Seeking Alpha probably more than ever because it won't take quite as long, or as much of my time on the investing group side. By consolidating everything through Substack, and let's face it, roar.pietrade.com. Okay. ETF yourself on Substack and roar.pietrade.com are like two peas in a pod. And what's happened is it's kind of made the Seeking Alpha thing, not to mention, I'm willing to admit, I'm very popular there as a writer. I got 11,000 people follow me. People come and go in the investing group constantly. I don't know if it's specific to ours. Okay. Maybe it's the price tag. I mean, the Substack is, very, very similar to the premium Substack, and it's $600 a year. So if you were paying more than that at Seeking Alpha, then, and I think everybody was, then it'd be fairly significant discount. Um, but it just got to the point where we felt we were, as I say, pushing on a string. It just didn't seem like a platform that meshed well with what I do. I'm not a stock picks guy. I mean, I can be, okay, but I didn't want to be just another stock picks guy. I want to teach people portfolio management. I want to teach them risk management. I want to teach them charting. I want to teach them more about ETFs, options, ladders, and of course, stocks too, in my way. So that's the reason, just so you know, and again, like for now, okay, it's business as usual with if you're in the Seeking Alpha investing group. But April 30th is the date that we believe they're going to close it off. Now, virtually everybody is probably signed up already at etfyourself.com. If you're not, let us know. And we are not going to double book or double bill, whatever, okay? Is very coordinated with those folks. And of course, contractually, from what we understand, I mean, it's between you and Seeking Alpha. We're just the group leader, okay? But between you and Seeking Alpha, they would prorate you for everything beyond April because they're not replacing us. We're resigning. They've accepted that, and so we're cutting that, and have an article out on Seeking Alpha yesterday. I'll put a lot more out there, but the investing group was a different thing. The investing group basically is merging, if you will, with the premium group, the $600 a year group at uh, etfyourself.com, and it's just going to streamline a lot. And at the end of the day, hopefully everybody appreciates that the best use of my time is research and coaching and looking out as a risk manager. And the more admin and marketing and stuff like that I do, the worse off it is for everybody. So that's where we are. All right. So I am going to close it there in terms of